Robschild, no investment advice. Welcome to the show where we view financial markets through crystal ball gazing. J.P. Morgan once said millionaires don't need astrologers, but billionaires do, and so we begin. Today is Tuesday, August 13th, 2024. Today's episode, I'm going to start with a little discussion of just reminding people that deflation is a bad thing. I bring this up because the markets today showed that the PPI was lower than expected, and it's taking it as a good thing because there's a higher chance of 2 cuts instead of 1 cut, which makes borrowing money cheaper, which is better for stock valuations because more of the earnings can go to the stockholders. It's pretty simple math when you really think about it. But the other side of that is, when you have disinflation and when inflation is going lower, in other words, you still have prices going up but at a slower and slower rate. As that happens, what can and often does occur is eventually you get to zero inflation and then you get to negative inflation. And that's deflation. That's when things are going down in price. But Robschild, I want things to go down in price. Stuff's way too expensive for me right now. I think deflation would be great. Well, okay, noted. The last time we had a problematic deflation was the Great Depression. So, but why would a Great Depression happen if things are getting cheaper? So let's just go over those points, just as a review in our heads. Even if you already know this stuff, it's always good to review why deflation is bad. I think especially right now, it's a good time to review this. Deflation is bad because, number one, it encourages sort of a wait, it'll keep getting lower mentality. So that couch that you've been wanting to buy, that car you've been wanting to buy, it's gone down in price by $1,000 and another $1,000 and another $1,000. So a lot of consumers, they end up putting off spending. They say, well, maybe I'll wait until prices are lower. And that's what happens, is that turns into a spiral effect. Because when prices are going down, it's not a good thing. It means that people that normally were getting paid a certain amount for a thing, now we're getting paid less. And it sort of unwinds the entire economy starting there. One way to think through this is stuff is forced to be sold at lower and lower prices until potentially being sold at losses. Now, you actually hear about this all the time. Believe it or not, every time a company sells somebody something, they're not always making a profit on that thing. Sometimes they have too much of it and they have to get rid of it because storing it is costing them too much, and they have the whole system. There's more trucks of more of it coming, so it's like nobody's buying this stuff, so we got to lower our prices. And it can get to the point where companies start selling stuff at bigger and bigger losses. So people are buying less stuff because they're waiting. They don't want to pay, and so inventories are building up, so they could be forced to sell at losses. Because everybody's waiting, no one is participating in the economy. Nobody, companies are not going to need workers as much as they did before. And so that turns into a lot of layoffs. But also, when, let's say, somebody quits and they got to replace this person no matter what. Well, new hires in this scenario can and will be paid less. This actually occurred in the news pretty recently. I believe it was Walmart that finally came out and said, okay, actually we're lowering now the new hire pay. And that does happen, and it continues to contribute into that deflationary spiral, so to speak. Now, with all of this happening, when inventories are being sold at losses, well, who cares? That means, I as a consumer, I'm going to the store and I'm getting more stuff for less money. That's good. Well, part of that problem is that, eventually it can get so bad that the losses are not just digging into the profits, but are digging into the money that the corporation is borrowing in order to try to make money from the bonds. So the money that they're borrowing can end up being in default, where the company doesn't it doesn't have enough income now to be able to even pay the interest on their bonds, and that can become a huge problem because when bonds default or can potentially default, companies are forced to sell anything and everything that the company owns in order to pay off the bonds, because that's what a bond is. A bond is a bond. You never, not pay your interest on a bond. That's what a bond is. Now, when a corporation's bonds actually default and the company says, okay, that's it, we can't do business anymore, we're going bankrupt, they have to sell everything, give everything they can to the bondholders, and nothing is typically left over for the stockholders, which is why the value of stocks at an intrinsic value drops to the floor. And many times, it is always said, stocks can and will go to zero when that happens. They become worth nothing. What often happens is a reorganization of debt. And so what the company ends up doing is saying, okay, we're bankrupt. The stockholders get nothing. They get wiped out completely a lot of the time. And the company goes to the bank and says, hey guys, thing is, we have a business here. We know how to make this work again. We were doing it before. We need to borrow money again. And then they get new money, and then there's new stock formed, which can happen. But any way that you look at it, a lot of people, everybody that has investments in stocks that see the value of their stocks shrinking at the same time, they see that they have less buying power as well, which adds to the mentality of not wanting to spend money, which is deflationary, and it means the economy is slowing. And that's how you get your recession and your depression. It's hard to find work. It's hard for people that can't find the work they want to pay off their bills to the companies. It's a whole circle where everybody kind of just loses everything and gives up. No one wants to hire anybody. No one wants to pay anybody anything for anything, and that's how the whole deflation ends up spiraling out of control. And I put this last note here: preferred shares and stocks can also default, and and that has to do with the fact that if a company, if you have a company that's been paying out dividends, every single year for the past 50 years, let's say, the same, increasing their dividend payment, and all of a sudden things get bad enough where they don't pay that payment anymore, many stockholders will see that as a default. They were expecting for sure I was getting that payment, even though it's not a real default. You can end up with something acting like a default on a stock. And preferred shares, some preferred share corporate structure of debt can count as defaulting. So that's why I added in there. Overall message: remember, folks, inflation is slowing down. Disinflation, which right now seems good until it keeps going down, and we can't stop it from going down, and eventually we get to that point where we're getting deflation. And remember, deflation is actually bad. It's actually, a lot of people consider deflation to be much worse than high inflation, not hyperinflation. Hyperinflation is probably worse than deflation, but deflation is worse than high inflation. And this is why the Fed and the government for COVID stepping in was a good thing, instead of it turning into this crazy depression where everybody went out of business because everything was closed and everybody just lost everything. They ended up with a situation where they went to high inflation, but now we're back to normal inflation. And my question is this train, are we going to zero? Are we going past zero? Or are we getting to this supposed soft landing where we get to 2% and we just stay there forever, like the Fed would miraculously pull off, which they've never done before in history. But we'll see how that all works out. On to the day's data and chart. PPI came out today. Headline PPI, in other words, including food and energy, came out lower than expected. The actual was 0.1%, expected was 0.2%, and the last was 2%. This is a month-over-month reading. This is for July. The core PPI of that same metric, interestingly, went up from the last and was higher than expected at 0.3%. Expected was 0.2%. The last reading of this was 0.1%. Now, the market pretty much ignored PPI, the core PPI, and just looked at the headline. The headline sort of is more important because it has a more direct, immediate effect on things, on the like actual real inflation that we're experiencing. But the truth is that, so what's leading all of this? Well, obviously it's the food and the energy. If the food and energy PPI one that included that went down while the core PPI actually went up, it just means that the food and energy they're like really tanking to push the whole headline PPI number. The headline includes food and energy with the core. The core strips out the food and energy. So short term, the market is acting like there's a slowdown right now. But longer term, with the core staying strong, says that like the bigger time horizon is still stickier with higher inflation there. And then PPI headline year over year, YOY means year over year, so compare last year to this year. The last month's year to year was 2.7, and this time it was 2.2. That's really cool. By the way, that 2.2 number is darn close to 2%, right? The target for the Fed. And so it's like, if we keep going in this direction, at least for the headline PPI, getting below 2% soon at a 1.9 is, in my opinion, highly likely at this point, and it's highly likely, I believe, to come sooner than later. Like I've been saying, the way I see the inflation thing was that, we went up and then sideways, and we thought it was transitory. That's when everyone was saying, oh, it's going to go straight back down. It dipped, and then it started curling up again, and then it went like to a much higher level. And then we got to like 9%, and then we went down, and it sort of stayed at 3% for a while, and now we're seeing it curl over. And so are we going to see the same motion on the other side of this mountain here, where we spiked, flat spike, and then we just spiked down, basically back down, went flat? Well, if we were on the other side of the equal, like symmetrical mountain, and we're in that flat period ticking down, well, my expectation is that, we will actually be accelerating that movement down, the way that I look at it. But I'm just a guy with a crystal ball. Core PPI year over year, that's supposed to say the actual was 3.3%, so a bit higher, than the last month reading of this. However you want to look at this data, the stock market, we leaned towards 2 cuts more today in the Fed funds futures. We flipped from 50% to like, we'll take a look at it in a minute. I believe it's 53% chance of a double cut now. But really, things are just 50-50 still, and we're waiting for the CPI. The CPI is more important because it's what the actual end consumer is paying. That's like the shortest time horizon, like look at what's happening right now. That's what the CPI. PPI kind of leads that. It's like, what are the people making stuff experiencing and how much they have to pay, more or less. But then on the consumer side, a lot of times it follows the PPI, but the consumer price index is the most important. It determines what the real inflation rate is for people. At least it's supposed to be. Some people make arguments on that. But anyway, tomorrow is that CPI reading at 8:30 in the morning. Could be big news one way or another. It'll be very interesting to see what happens. Daily reminders 2-year, 10-year yield curve inversion is still past its second birthday. We are still currently inverted for the longest time in history, as far as I know, which typically indicates, we might be headed into the worst recession or depression, pretty much ever. And then also the sun rule has been triggered, suggesting that the recession has indeed already started. On to charts. I said yesterday incorrectly that I thought that this high to high on the S&P 500, dragging it down to this low here, that this line would hold up here from yesterday, this little red candle. I don't know if you can see it too well. Let's zoom in a little bit. This red candle, and I thought that I said smart money is shorting here. Well, if they did, they might have gotten stopped out today, because the stock market really ripped higher here. And this trend line is not a super long-term trend line. Oops. It's this one. So we're going to put that back up there, and we're going to zoom out and see where another trend line might be. And if you take the bottom from October 23 and have it hit bottom, 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 we break through. This is going to provide a lot of resistance here. This could be potentially, at this point, now that we got over that line that I was expecting to hold, this line will be a stronger line here, because it has a longer date on it, and plus we were on the other side bumping on it for a while, which means that it is very, very strong right now. We haven't tested it once. On the first test of this, it should reject pretty strongly. I don't know if that means that it can turn over here or not, but we'll see. VIX futures curve. I've been noting how the August and September contracts here have been above the November contract, and how unusual that is. And actually today the front of this is actually dropped, but it is still interesting that this October is still highly elevated here. The market is sniffing out pretty bearish things going on. A lot of volatility coming up next month, or in 2 months rather, in October. As you can see, it is massively high at this point. It is above all the way out to I believe this is March on the VIX futures term structure. And so this is currently pricing a lot of volatility in October. Looking at the VIX itself, we are now it's really calmed down. 18, just as a general price, is relatively low. If you zoom out from a longer time horizon, 18 is not, we're no longer in panic mode. I said the market was still on fire yesterday, being above 20, but now that we're below 20 in the VIX, the fire is actually dying off right now, at least for today. Could all of a sudden we have another canister just blow up like the CPI report, and do a rug pull on the stock market tomorrow? Certainly that can happen, but nobody knows, because no one has a so my crystal ball on this issue has been a little foggy. TLT long bonds, I have 55% of my portfolio net worth, whatever you want to call it, in this. We had a little bit of a jump today. If we take a look at, one way to look at this inversely is the 10-year yield, the 10-year Treasury note yield. This certainly looks, pretty clearly like a dead cat bounce. It clearly, this clearly wants to go lower here. So I still think being in bonds is the best possible spot. While inflation is cooling, it allows interest rates to go down, and if we get a major panic in the stock market or any other crazy thing that that happens, like another thing like what happened with the Japanese yen carry trade that blew up, bonds will go to the moon here, I believe. But like I'm saying, the fire is dying down. In fact, junk bonds doesn't see a fire at all. Junk bonds are pretty highly valued right now. People are paying enough for these junk bonds that there's really no worry of default here. No one thinks that any companies are going to go default that are, normally higher at risk, but the higher risk is not being very well priced in now. So that's where that is. On the Fear and Greed Index of CNN, ever since the yen carry trade blew up, we've been in extreme fear, and believe it or not, by this metric, we are still considered to be in extreme fear. As I mentioned at the beginning of the show, the September meeting Fed rate, we did flip. Funny, only 3% more increase to the double cut versus the one cut. And so this, for all practical purposes, is still 50-50. For the stock market to really jump here, it's it's getting ahead of itself. More than anything, it might be people getting out of their shorts or covering their shorts, forcing the market to kind of just like melt up real quick, because the risk of there only being one cut is now lower. Sorry if you can't follow all of this. If you watch enough of these shows, you'll eventually get the lingo here. But anyway, that's actually all I have for you for today. Be careful out there, folks. Choppy waters ahead. Hope you enjoyed. Thank you for watching. Robschild.